Good. Good evening, class. Please confirm that you can hear and
Good
see
evening,
my.
sir. Can hear and see you.
Okay, great. So you are welcome to another class on corporate reporting for my part. So today, what we want to try and achieve today is to finish up with financial instruments, because next week we will be starting with IFRS 16 on leases. I can remember that last week we started with financial instrument, and we basically looked at IS 32 that considers the definitions. We looked at the definitions, and also I can remember that we looked at recognition and some aspect of measurement. Today we are going to finish all that up. And last week we went straight to the definition of financial instrument, and we learned that financial instrument is any contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. So we established firstly that a financial asset, a financial instrument must be a contract. It is a contract. And this contract must have two parties. One party must have a financial asset, and the other party must have a financial liability. And we then picked on this element of this definition of financial instrument one by each, so that we can understand it before we then went ahead to give examples of financial instrument contracts. We understood that a contract need not be in writing, but it must have clear economic and legal consequences. It's that consequence that actually makes it a contract, not just any agreement. It must have consequences, meaning each party are expected to perform. Then we looked at financial assets. Basically, I focused financial asset on three things. I said, firstly, financial asset is cash. Financial asset is also equity instrument of another entity. And financial asset is also contractual right to receive cash. That is the financial asset. And looking at those three things, cash, equity instrument of another entity, which simply means that you have invested in equity or you have bought shares in another company. That is equity instrument of another entity. And we also said it is a contractual right to receive cash. Majorly when this usually arises when you have invested in a debt instrument. To put it simply, when you have lent somebody money, you would have a contractual right to receive cash. That was basically what we focused on last week. The other part of that definition that I said is not our concern here, as far as this exam is concerned. Then there were some examples of financial assets we looked at, like trade receivables, lease receivables, equity instrument of another entity, cash or check, all of that. Then we went on to financial liability. We said financial liability is a contractual obligation to deliver cash. Contractual obligation to deliver cash. And majorly, we'll be looking at trade payables, notes payables, loan payables, and all of that. And I then explained to you that physical assets like PPE or even intangible assets are not financial assets because they don't give rise to contractual right to receive cash. When you have an item of PPE like a motor vehicle or a plant, they are PPE because you must owe them to use for production or supply. You must put them to use. But when you have a financial asset like a trade receivables, you don't have to do anything. You have a right to receive cash, which is the third part of a financial a financial asset. Then we looked at examples of a financial instrument contract. We said the first one was credit sales. We said a credit sales transaction is a financial instrument transaction because it gives rise to financial assets, which is trade payables, trade receivables of one entity, and financial liability of another entity. That's for credit sales. We looked at bank savings also. We say when you deposit money in the bank, you also have a financial asset. While the bank will have a financial liability, loan transactions has the same analogy, lease contract has the same analogy, purchase of treasury bills, we explained that also, and we also explained ordinary share transaction, meaning when you buy shares in a company or when a company issue out its shares, it is a financial instrument contract also because it's going to give rise to financial assets to the buyer of those shares or to the investor. That's the guy that will have financial asset. Whereas the issuer of the shares would have an equity instrument. Equity instrument. So I pointed out that for ordinary share transactions, you have to be very careful so that you will not think the issuer has a financial liability. The issuer never has a financial liability when what is issuing is an ordinary shares. When what the issuer is issuing is an ordinary shares, what the issuer will have is share capital or equity. While the buyer or the investor is the guy that would have a financial asset. We looked at all of these last week. And I can remember that we looked at these questions. And I can also remember clearly that I was calling you one by one, that you should answer this. And we had a lengthy discussion around this part last week. Then we moved on to recognition and derecognition. We said majorly that you can recognize a financial instrument in line with IFRS 9 because that's the standard that deals with recognition and derecognition of financial instruments. We say you can only recognize a financial instrument when an entity becomes a party to the contract or when the company becomes a party to the contract, then the financial instrument should be recognized. And an entity can become a party to the contract either at the date of the agreement or at the commitment date. Either at the date of the agreement or at the commitment date. That is when it becomes a party to the contract. We also said financial assets should be derecognized. That's financial asset now. This recognition is looking at everything together, recognition of financial instruments. But the recognition now is looking at each element one by each, starting with financial assets. We said you can recognize the financial asset when the contractual right to the cash flow from the financial asset has expired, or when the entity has transferred substantial risk and reward of ownership of the financial assets to another party. And when we say transfer of substantial risk and reward, I told you last week that this means there is an unconditional sale of the financial assets. That is when you have transferred the risk and reward attributable to ownership, meaning you have sold. It's just like selling your shares. When you have shares in a company, that is the financial asset. When you sell those shares, that means you have transferred your risk and reward to another party. Your risk and reward attributable to ownership of that financial asset. So that means you have sold. Now, the standard is talking about an unconditional sale. I told you that means there could be conditional sale. And there is conditional sale where an entity sells and it says that, okay, well, I might, in fact, I want to buy it back. I want to buy it back. When is the one that is dictating the price at which he's going to buy it back? IFRS 15 on revenue, we say, no, that is not sale. You have not sold because you have not transferred substantial risk and reward. You sold something and you are saying you buy it back. You are still dictating the price at which you will buy it back. That means you cannot recognize that financial asset because you have not transferred risk and reward. However, if in this case now, a sale of financial assets and you have an option to repurchase the financial asset at its fair value, meaning that you are not the one dictating the price you want to buy it back. You are going to buy it back at its fair value. In that scenario, we can say, okay, the fact that you are initially selling. Can you still hear me, please?
Yeah, we can hear you, sir.
Oh, okay, good. So we discussed all of these last week, but majorly, you recognize a financial asset when the contractual right to the cash flow has expired or when you have transferred substantial risk and reward. So majorly, this transfer of substantial risk and reward majorly means that you have sold the financial asset. So it could either be an unconditional sale or a conditional sale. That's what this two is talking about. Okay. But when the sale is conditional, you have to be very careful. It must be at fair value. Conditional means that, okay, I'm selling, oh, but I might buy it back, oh. But if I'm going to buy it back at fair value, meaning at the prevailing price at that time, then that's still good because you have transfer risk and reward. That means that whoever you are going to buy it back from is going to sell to you at market price, which is okay. Now, we also spoke about the recognition of financial liability. And we said a financial liability is derecognized when it is extinguished. We said a financial liability is recognized when it is extinguished. And when we say extinguished, we are talking about when the obligation is either settled or discharged, or it could be cancelled, or probably it could have expired. Then you recognize your financial liability in those cases. However, there are some other cases or other scenarios I wanted you to note relating to the recognition of financial liability. One of it is the fact that an entities could exchange one financial instrument for another instrument that have different terms. When you exchange, it means that the one you are giving up, you recognize that from your books. So that can also lead to derecognition. Also, there could be modification of the terms of an existing financial liability. Modification means that either there is a change in the interest rates, or maybe probably there is a change in the terms or the repayment period. When those changes, that's a modification of an existing financial liability. This could also lead to derecognition if the modification is substantial. And a modification is substantial where the differences between the old cash flow from the original terms and the new cash flow from the new terms, when the difference between them is at least 10%, okay, then that could also lead to the recognition. So I've never seen any ICANN correction that has gone into the recognition as a result of either exchange or substantial modification. We have not seen, or they have always stopped at this point that I gave you, but there's no harm in knowing this also. So usually when you derecognize, it could either lead to a loss or sale on that, a profit or loss on that derecognition. So these are usually recognized in profit or loss. So we spoke about that last week. Then we also moved to measurement of financial instruments. So for measurement of financial instruments, we are going to pick each of these items one by each: financial asset, financial liability, and equity. So we are not really going to talk about equity, really, because equity means share capital and reserve, majorly share capital. And how do you measure share capital in Nigeria? Share capital is measured at nominal value. And where do you get nominal value? You get nominal value from your CAC documents. So it depends on the country you're operating from. That will determine how you measure your share capital. In Nigeria, share capital is measured at nominal value, which you find on your CAC document. If it happens that when you're trying to now raise more money, you now issue those shares above their nominal value, any amount above the nominal price of those shares, those are also recognized and measured in your share premium account. And that is it for equity instrument. So I don't see ICANN exam asking you that, but I mean, these are basic things you need to know around share capital measurement. Then we started with measurement of financial assets. You see, when it comes to financial assets, I already told you that when I was defining financial assets to you, I told you that there are three things. One is that it's cash. The second thing is that financial asset is when you buy shares in a company, that is investment in equity. And financial asset is also when you lend somebody money, which usually gives rise to contractual right to receive cash. The focus for today is not going to be the first one, which is cash. Yes, cash is a financial asset, but how do you measure your cash? How do you determine how much you put in your books for your cash? It's your cash. Your cash is your cash. If you have cash in hand of 50,000, it's 50,000 you put in your books. If you have cash in bank of 100,000, it's 100,000 you put in your books. So your cash is measured at your cash, right? Then the two next one is where I really paid a lot of attention. The first one I looked at here was equity and debt. You see, when it comes to measurements, the first thing is the initial measurement. And when it comes to financial assets, majorly is around investments. Is either you are investing in debt, meaning you lend somebody money that will give you contractual right to receive cash, or you bought shares, which is investment in equity. You see, the way it is initially measured is just at the transaction price, which is usually the amount you have invested or the amount that was paid for the instrument. That's the initial measurement. So when we are talking about measurement, we always first is what's the initial measurement? Meaning, how much will be the first amount at which you enter this transaction in your books at the date of the transaction? That's the initial measurement at the date of the transaction. Now, let me pick it one by one, focusing on what happens at the date of the transaction, starting with when you buy shares in another company, which I call here investments in equity instruments. You see, when you buy shares in a company, yes, in your books, you recognize it at the amount you have paid for those shares. But I need to understand that these shares, when you buy shares in a company, it will lead to a lot of things. Like what Mr. Kazim is teaching you on group account. That group account, preparing consolidated account, is as a result of buying shares in another company. When you buy shares in a company, now your shares become so huge that, I mean, buying shares means buying ownership. By the time you have significant influence, then that one is outside the scope of what we are discussing here. That one will be dealt with in IAS 28, which I'm sure Mr. Kazim is already dealing with. Or when the shares you have bought gave you control, that is, you have bought so much shares that you are the largest shareholder. That gives you control. And that other party becomes your subsidiary. Like when Otedola was buying shares in First Bank, he bought so much that he had control. He's not the chairman of First Bank. What we are talking about here is not the one that will give you either significant influence or control, or even joint control. What we are talking about here is just normal, simple investment. You just bought some shares. I mean, it doesn't really give you necessary decision-making power. So that is what we are looking at here. So you see, when you have that kind of situation, that investment, we call it financial asset, and putting it in your books, I've mentioned it, that the date you bought those shares, you will record it in your books at the transaction price. However, at that same date, you look at the second paragraph, at that date of acquisition of that shares, you must ascertain why are you buying those shares. It's very important. It's very important for users. You need to ascertain why you are buying those shares. And when you are buying shares, you see, people buy shares for two reasons generally. Is either they are buying it just for speculation or for the short term or for trading. They're just buying it. They're okay. Instead of me keeping this money in the bank, let me just buy some shares, right? So if the price goes up, they will sell. Then they keep using it to trade. That's one reason, speculation. Another one is for the long term. A lot of people buy shares for their children. They buy shares for their next generation. Those ones are buying it for the long term. That's the two reasons. So we believe that when you buy shares and you want to recognize it in your books, user that is looking at your financial statement must know why you have bought those shares, because it can aid his own decision making. You see, when you buy shares for the short term and you want to recognize that shares as financial assets in your books, you don't just put it as financial assets. You are going to classify that financial assets at fair value through P or L. That is when you are buying it for the short term. But when you are buying it for the long term, you are going to classify that financial asset at fair value through other comprehensive income. This is happening at the date you bought those shares. You need to know this immediately, because that is going to determine how you're going to describe that transaction or that account in your books. So you won't just call it financial assets. You won't just debit financial assets. You would describe it completely as financial assets at fair value through POL or financial assets at fair value through OCI, depending on your intention of buying those shares, depending on your classification. So generally from that explanation, is either you are classifying it at fair value through POL or you are classifying it at fair value through OCI. All these I've explained last week. I'm just going over it again because I know that we might not have read it. Now, going forward is I looked at this example, this very simple example, where a company bought 5,000 units of shares at 2 naira each. And the major thing here is that the guy intends to sell those shares before the end of the year. We're not asking how will it be initially measured and classified. This was a very straightforward question. It's just for you to see sense in what I was explaining so far. So you see, when you buy shares, it's a financial asset. And in your books, you initially measure it at the amount you paid. So when you buy 5,000 shares and you pay 2 naira per share, that means in your books, that financial asset will be at 10,000 naira. And now, since this guy intends to sell the ordinary shares before the end of the year, that means he actually bought those shares for speculation. He bought it for the short term or for trading. Therefore, he's going to classify it at fair value through POL. So when he's opening the account, he won't just call it financial asset, but rather he to call it financial asset at fair value through POL. And of course, he's going to credit bank because he's parting away with money. So that is just to make sense out of what I've been talking about. And at the end of the year, which I call subsequent measurements, at the end of the year, that financial assets will be measured at fair value through POL or at fair value through OCI. And the difference between measuring at fair value through POL or at fair value through OCI, the difference is basically how you treat changes in value. How you treat changes in value. Because when you buy shares, like the one I gave you as example, that example one that they bought shares for 2 naira, at the end of the year, the price is not going to remain at 2 naira. It's either going to go up or comes down. And you see that change in value, if it goes up, that means you need to update your financial asset to the new value. Of course, since it's a financial asset, you debit it. The gain depends on how you have measured it and classified. If you had measured it at fair value through P&L, that gain is going to be recognized to P&L. If you have measured and classified at fair value through OCI, that gain is going to be recognized to other comprehensive income. So the difference between these two is just where you put your gain or losses. And another point is that the classification at the beginning of the year must be consistent with the measurement, meaning that if you classify at fair value through P&L, you must measure it at fair value through P&L. If you classify it at the beginning at fair value through OCI, you must measure it at fair value through OCI. They have to be consistent with one another. And the final thing I mentioned is that if you had involved like a stockbroker and you now incur transaction costs when you were buying those shares, you say those costs is either you expense or capitalize it. And that depends on how you have classified it at the beginning of the year. If you have classified it at fair value through P&L, the money you pay to your stockbroker, which I call here transaction costs, should be expensed. That if you have classified it at fair value through P&L. But if you had classified it at fair value through OCI, that transaction cost must be capitalized. When I say must be capitalized, I mean that it should be added to the initial costs incurred on that financial asset. Now, then, still on financial asset, the next one is debt investment. Debt investment. You see, when you invest in debts or debt instruments, and let me write it in full, investment in debt instruments, it simply means that you have lent somebody money. And when you lend people money, the amount you recognize in your books at the date of that transaction, that one is not difficult because it should be recognized at the amount you lend the person. So it's simply at the transaction price. So that is not difficult. However, what I need you to note around debt investment is that when you lend somebody money, they will always give you interest and principal. They will always give you interest and you will always collect your money back. This one is different from investment in shares, where you will not collect your money back unless you want to sell your shares. But when you lend somebody money, you would have agreed the interest you will collect. You would have agreed when you are going to collect your principal. And that is going to reflect in how we are going to treat it. So when you lend somebody money, the same way like investment in equity, you need to ascertain why are you investing in these debts? And that would determine the classification for that debt, right? Remember, for equity, when you invest in equity, I said you classify it either at fair value through OCI or you classify it at fair value through P&L. But for this guy, there are three classifications here. One is at amortized costs, two is fair value through OCI, and the third is fair value through P&L. And how would you know which classification? Don't forget, the way you know which classification the equity investment goes, the one I taught you earlier, that one depends on your intention of holding it. And it's either you are holding it for trading or for the long term. If it is for trading, we said that one should be fair value through P&L. If it is for the long term, we said that one should be fair value through OCI. This one is quite different for debt investment. You see, for debt investment, what determines how you classify it at the beginning of the year is these two things that I put as A and B. Number one is the entity's business model for managing the financial assets. Forget the big English. What this A means is how you want to make money from that financial asset. That is what it simply means. When we say business model, the business model is how you want to make money, right? Or their contractual cash flow characteristics. Forget this big grammar also. This one is just talking about, is there a contract or not? Is there a contract like is there a contract that specify how he's going to make money? That's what it means, right? So it's these two. When you analyze them, that will determine how you're going to classify them. So before you can classify at amortized costs, right? Before you can classify at amortized costs, number one, your business model must be that you would collect interest and principal. And of course, you also receive your repayment at maturity. But again, maybe before I even go on this amortized cost, let me tell you generally the way you can make money from a debt investment is either of these two. Number one is either you are just going to collect interest and principal, which is like a constant thing. Is constant when you borrow people money or when you lend people money to collect interest and principal, right? That's one. Or in addition to collect interest and principal, collect interest and principal, as well as sell the financial asset. So business model is either of these two. Number one, just to collect interest and principal alone, meaning you will not sell. Whatever happens, you will not sell. You don't have intention of selling, meaning you want to hold it to maturity. Fine. The second one is you will collect interest and principal, because when you lend people money, you always collect interest. It's always is a feature of lending people money, because that's the only income or profit you can make. Or in addition to collecting that interest and principal, you can as well sell. Selling in the sense that maybe you borrow the guy money and he's giving you 5%. You could get a better yield somewhere else. Maybe you see another person that is ready to give 8%. So you can just sell that one and go and invest in another. So that's the business model. You see, this contractual cash flow means that there is a contract. There is a contract that specifies collection of interest and principal. It's me, don't complicate these things. It's as simple as it is. This second one means that there has to be a contract that says that, oh yes, we have agreed that you will collect interest and principal. Now, with this understanding, you can classify a debt investment at amortized cost if the business model is just this one. That is, just to collect interest and your principal. That's your business model. And this contractual cash flow test means that there has to be a contract that specifies that, okay, truly you will collect interest and principal. And that's amortized cost. Then these other ones, I showed you how you determine amortized cost, which I'm going to come to in a jiffy. But before I go there, I want to tell you the second one, how you can classify fair value through P&L, how you can classify a debt investment at fair value through P&L. And this would happen, you classify a debt investment at fair value through P&L. Again, looking at the business model and the contractual cash flow. The business model is that second one I mentioned, where you, in addition to collecting interest and principal, meaning you collect interest and principal, and you might also sell the financial asset if you see the opportunity, right? If you see the opportunity for an higher yield, you would sell. So before you can classify at fair value through POL, the business model is that you want to collect interest and principal, and you can also sell the assets. You can also sell the financial asset. And this contractual cash flow is just talking about that there should be a contract that says that, okay, we have agreed that you collect interest and principal. So you see, identifying the classification for debt investments is majorly around the business model and the contractual cash flow. And the business model is nothing beyond how you are making money. If the way you want to make money is just to collect interest and principal, then you're probably going to classify. In fact, you have to classify it at amortized cost. But if in addition to making interest and principal, you can also sell, then you should be looking at fair value through through OCI. And the third classification, which is fair value through POL, this one is a default classification. What do I mean by default classification? It means that ordinarily or primarily, debt investment should be classified at fair value through POL. They should be measured at fair value through POL, ordinarily. However, if you don't want to measure it, then that is where you will now go and start looking at the business model and the contractual cash flow, which will now dictate whether you are going to classify it at amortized cost or at fair value through OCI. But by default, the default classification is mostly fair value to POL. Now, in the exam, it's going to be amortized cost you're going to find there in the exam. I can tell you this confidently. It's amortized cost you will find. So let me go back to this amortized cost, where the business model is that you collect interest and principal, and there has to be a contract that says that you collect interest and principal. Now, without too much unnecessary details, let me give you two scenarios. I will need your maximum attention here. Maximum. Let me give you two scenarios. Number one scenario is this. You lend somebody 10 million naira, and the guy is going to pay you 5% per annum. And the loan is for 3 years. And at the end of the third year, of course, he will pay you back your principal of 10 million. You see, commonly, this is how most debt works. I mean, these simple ones, this is how they work. You borrow the person pays you interest every year, and that is it. So this one, when you borrow the person 10 million, to enter it in your books, you just need to put it in your books as a financial asset. And since it's a 3 years financial asset, at the end of that first year, you just put it in your books as a non-current asset. Since you are not going to get your money back until after the third year. So like that. And at the end of that first year, you just recognize this 5% as a finance income in your POL, which is 5%, is always calculated on the amount you would borrow the person, which the examiner will call principal amount. So this rate, it's fixed every year. You always get 5% on the principal. It won't change, right? It's fixed on the principal. So every year 1, you are getting 500. Year 2, you are getting 500. Year 3, you are getting another 500. So that goes to show that the money you are making or the profits on this investment you have made is just 500 every year over the 3 years. And that 500 simply goes to P&L. You see, this 500, it's serious that if a company fails to pay at the end of a particular year, I mean, it's always a sign of a liquidity problem. And you can even file for liquidation for such a company that fails to pay because it's a contract, it has to pay. It's something you will collect. And in practice, even in reality, you'll find out that companies pay it in advance. Companies pay it in advance. I don't know if any of you knows about piggy vests. I mean, some of you would know it. They have a feature on their app called Safe Lock. You see, when you Safe Lock, what you're doing is you are fixed depositing your money. You already have the interest they will pay you. They credit you with the interest in advance. Credit you. So you can go and use your interest to do whatever. So it's something they must not fail to pay it. So you are sure that you're going to make 1.5 million. Just like recent treasury bills that the government put out. If you had bought it, those ones too, they pay interest in advance. So you'll have just moved on and the annual interests for the most part. Okay, so that's this one, quite straightforward. Now, let's see the one that you might, that is not that straightforward, which is this one. Look at this scenario now. Look at this one in this second paragraph. This guy invested 10 million in loan, meaning he lent somebody money in 2001. And is still going to collect 5% every year. However, the loan is for 3 years. At the end of the third year, they will pay him back 11 million. They will pay him back 11 million. Okay. Now, my first question in this class is this. How much is this guy making over the 3 years? Don't forget, in that first scenario, he was making 1.5. How much is he making here over the 3 years? I need somebody to tell me the right answer. How much is he making over the 3 years in this scenario?
2.5, sir.
That's correct. 2,500. That's absolutely correct. Now, you see, the challenge is this. The 5% is clear that he's going to get it every year, and he's going to put it in P&L every year. You see, that extra 1 million, which is a premium, because he invested 10 million, he's getting back 11 million. That 11 million, he's not going to get it until after the third year. Does that mean that extra 1 million will be recorded in the books at the end of the third year? Should it be recorded in the books at the end of the third year? If it does that, that is wrong, because that's totally against accrual concept. Accounting is not that way. We do not recognize income in our books when it is received, but rather we recognize income in our books when that income is earned. This extra 1 million is not earned at the end of the third year. It is actually earned over the 3 years. So we do not wait on the end of the third year before we recognize this income. We would actually share this 1 million over the 3 years. We will share it over the 3 years. IFRS 9 has made the way for us to do that. That goes to show that IFRS 9 says that, you see, this extra 1 million, you should recognize that as income over the 3 years using an effective interest rate method. Using an effective interest rate method, which simply means that you need to convert this 1 million to rate and accumulate it with this 5%. Don't bother about how that is determined for your exams, because they are going to give it to you. That effective interest rate will be given to you. So the examiner in this case gave us the effective interest rate of 8.08%. This 8.08% represents 5% and a portion of that 1 million. 5%, a portion of that 1 million. So that means that what goes into our P&L as income every year is not going to be just this 5%. To be this 5% and a portion of that 1 million. And that is the work this 8.08% is going to do for us. So if you have an effective interest rate or whenever an examiner gives an effective interest rate, know that means the examiner wants you to use it. That means that the guy is earning beyond just the nominal interest. He's also earning additional income. That's why they are giving us an effective interest rate. So use that. And whatever you get from that is what goes into your P&L. And how does it work? We use this amortization schedule. We use this table. Looking at it, you borrowed, or sorry, you didn't borrow. He lent the money out in 2001, 10 million. I call that balance at January or balance at the beginning. What I will recognize in my P&L is this effective interest rate of 8.08%. I mean, it's not always 8.08% in all cases. It varies. Some questions might give you any rate. Whatever rate they give you, just use it. 8.08%. By the time I apply my 8.08% on my 10,000, that gives me 808. It is this 808 that is my income for that year, meaning the 500 naira and a portion of that 1 million. 808. But the amount I received was not 808 for that year because I'm not going to get that premium that year. I will just only get my 5% interest. And the 5% interest is always on the amount invested. Always on the principal amount. Always. The nominal interest is always on the principal amount. So you will always get a fixed interest for this one. So I actually received 500. I earned 800. I received 500. Remaining 808 minus 500, that's 308. But don't forget, he's also owing me 10,000. So the total, both principal and interest, that I'm expecting now is 10,308. You see, this you can have as an additional information in a question 1 question in your exam. And all the examiner simply needs from you is just to know that this is the effective interest rate you are going to use to determine your finance income that goes to your P&L. And this amount is what we call amortized cost, which is the 10,308. And it is this amount that you just put as non-current assets. You call it financial assets at amortized cost. I'll show you. And that's it. Mostly it will be that. But I mean, let's see it through here. In the next year, year 2, this 10,308 will become a brought forward amount. Our effective interest will now be calculated on this outstanding balance. That gives us the 833. Of course, we are still going to receive our interest. The interest is annually 500. By the time I accumulate 10,308 plus 10,833 minus 500, that gives me 10,641. In year 3, I bring that forward, 10,641. I have my effective interest by applying this 8.08% on 10,641. That gives me 859. I received 500. Then I have a balance of 11,000. You will see that this 11,000 coincide with how much I'm expecting to receive at maturity. And that's, they just simply need to pay me back the 11,000 and my account will just close and everything is over. And don't forget, in year 1, we will have recognized this 808 as a finance income in P&L. And this 10,308, because this is due, or I'm expecting to receive my money back in like after 2 years, which is 2003, is going to come in under non-current assets. And this other 833 in year 2, it goes to my P&L in year 2. And this 10,641, now that I'm expecting my money next year, so it's going to be a current asset. So 859 in year 3, we go to P&L. And at the end of year 3, they simply pay me back my 11,000. And this is how amortized costs work. Examiner will just simply give you effective interest rate. Now, to show you that they know what they are doing, somebody told me that in this second scenario, that the income we're making over the 3 years is 2.5. And it is going to help us spread that 2.5 over the 3 years. Hello, can you hear me? Let me. I want to sort something, but I need you to help me confirm this, because I would expect that this addition of this 808, 833, 859 should give us 2.5. Can we confirm it? Because since the income we are earning over the 3 years is 2.5. Who is confirming it?
Yes, sir. It's giving 2.5. I just did.
Okay, good. So we're on the right track. All right. So do you have any questions?
Yes, I have a question, sir. Please, I missed something on the investment in debt instruments. When you said something about classification by fair value through P&L, I didn't really get the conditions.
Through P&L, right?
Yes, sir.
Okay, so I mentioned that one is a default classification, which simply means that primarily debt investments, when you lend people money, they should be classified at fair value through P&L. Primarily, they should be classified at fair value through P&L. That is as simple as that first. That primarily debt investment should be classified and measured at fair value through P&L. So if you don't want to, that is when you now start looking at those tests, business model and contractual cash flow. Did I answer your question?
Sir, I do not really understand it. Like, I'm still confused. You said classification by amortized cost, right? That there must be collection of interest and principal, and then secondly, there must be a contractual agreement. Then under classification by fair value through OCI, you said there must be an agreement to collect interest and principal, and in addition also be able to sell, right? Be a contract agreement. So then classification by fair value through P&L. Now I want to know like the two conditions that will necessitate the classification based on P&L.
Okay, I will still have to repeat what I said again. That through P&L, you don't have to use those conditions. That it is a default classification. That one does not follow that pattern of the first one of those first two that you have rightly mentioned. Is a default classification. That means primarily when you invest in debt, when you lend people money. So if you don't want to stress yourself looking at business model or contractual cash flow, you can just classify it at fair value through P&L. It doesn't have any basis. Just classify it at fair value through P&L. So that's what it is. So which is what I've said before. So
Thank you.
if you don't want to do that, then you can then start looking at those business model tests, whether you are collecting just interest and principal, which is amortized cost, or whether in addition to collecting interest and principal, you can also sell, which is fair value through OCI. But P&L is a default, just primarily just classified there. But believe me, I mean, that's what it is. Okay. So that's that for debt. Now, okay, let me use this to explain these amortized costs, right? Let me use this same example to explain fair value through OCI and fair value through P&L. You see, for fair value through OCI and fair value through P&L, you still have to do this table if there is an effective interest. You still have to do this. So this is a constant thing, because when you lend people money, you collect interest. So you have to calculate interest and all of that. Where the difference lies is this. If the examiner wants you to use either fair value through OCI or fair value through P&L, he will specify it, or they just give you those conditions that I mentioned earlier. So if, for example, it's fair value through OCI, for example, that means the examiner would have to give you a fair value for each year, because you cannot establish a fair value. And this standard is not even teaching us how to determine fair value. So they would have to give us a fair value. When they give us a fair value, they can give us, let's say they give us 10,500 as fair value, assuming. That means that, for example, in year one, the examiner tells you that, measure it at fair value through OCIU. You still do this that we have done. But instead of putting 10,308 in your books as non-current assets, is the fair value the examiner gave you that you are going to use. However, that means there will have been changes in value. If it's, for example, 10,004, it's interpreted as that your asset has increased from 10,308 to 10,004. That means you have made a gain of like 92. 92, yes. See, that 92 is a gain. If it is fair value through OCI, that means that gain will go to OCI. If it is fair value through P&L, that means that gain will go to P&L. And that's the difference. That's it. So majorly, you find the examiner really, if they really want you to do calculation, it will be more focused on amortized costs, just making sure that you know how to use effective interest rates, and you know how to do this schedule, and knowing that is this one that goes to P&L, and is this figure that goes to your balance sheet or your statement of financial position. So that is it for financial asset. And so let's go to financial liability. So for measuring financial liability, and when we say financial liability, you know that means you are borrowing money. And when you're borrowing money, the way you put it in your books at the date you borrow the money, is still the amount you have borrowed. It is still recognized in your books at the transaction cost. But majorly, the standard says that initially these are recognized as net proceeds. Net proceeds. So meaning that if there is any transaction cost or issue cost, that should be net off from the amount you borrowed. It's going to be clear with this scenario I want to give you now. But before that scenario, so when you have a financial liability, that one are majorly, and it's majorly focused on amortized costs. They are classified at amortized costs, which means that they are measured at the end of the year at amortized cost. So it's similar to that debt investment I just taught you. It's the same, it's not similar, it's the same thing. The only difference is that since this one is liability, that's interest, instead of now being finance income now. For financial liabilities now, it will be a finance cost. That's just the difference. Okay, so everything I actually mentioned on that financial asset for debt investment applies here. So that means that before you can classify it as amortized cost, your business model is that you want to pay interest and principal, and there's a contract that says you pay interest and principal, right? So the same, but this one doesn't have fair value through P&L or fair value through OCI. It focuses on just amortized cost. Okay, now I will do a third scenario here. I will do a third scenario here to finalize financial liability. But before I go there, I said that when you borrow money, you recognize it initially at net proceeds. What I mean by net proceeds is that if, for example, you borrowed 10 million and you gave a broker 200,000, in your books, what you would put in your books is the net of 9.8, not 10.2. It's going to be 9.8. That's because that's the money that will actually settle in your hand, because you have borrowed 10 million. You now give a broker. You have most likely be giving the broker out of the 10 million you borrowed. So usually, in fact, if you go and take loan from the bank, which is a financial liability, the bank will even, is the net the bank will give you. They will remove they call it management fee. They will remove it in advance. They will just hand over the net to you. So financial liability is entered in our books and net proceeds. I mean, in a financial asset scenario, the one I discussed earlier, they could give you that the guy also incurred costs to invest. You could involve a broker. That one now, if you had invested 10 million, you now pay the broker. In that situation, the standard says that if the investment is classified at amortized cost or at fair value through OCI, you capitalize it. And capitalizing it for asset means you are adding it. So it's going to be 10,002, because that one is like money is going out from your hand twice, from the investment and from the transaction cost, right? But if it is fair value through P&L, you expense the transaction cost. But I'm more focused on the one you are capitalizing to distinguish it from this liability. Liability too, you are capitalizing this 200, but because your money is going out now and this 10 million came in, so is net you are going to, that's actually settled with you, and that is what you are going to recognize in your books as a financial liability. Now, having cleared net proceeds, let me look at this final scenario. So you have this guy Wasiu, right? So Wasiu issued, when you see issued, I mean I'm the one borrowing. I've issued like a contract, like a debt instrument that please come and borrow me money, right? So I issued 10 million, meaning I want to borrow 10 million, and I'm saying I will pay 5% per annum. I will pay 5%. And I incurred issue costs, meaning I involved a broker that I paid 200 to. Then these loan notes are repayable at a premium of 1 million. Okay, just like the previous one. That means that when I'm paying back at maturity, I'm going to be paying back 11 million. That's what they mean by this premium of 1 million. So of course, that means the cost of this guy is not just 5%. It has other costs. That's why they are giving us an effective interest of 8.85%. Okay, so this 8.85%, just like I've explained, is something similar. Is the one that will convert this extra cost to interest, and is this 8.85 that is his cost, not just this 5%. So the interest is incurring is more than 5%. Is actually 8.85%. So look, this time of the loan is 3 years, from 2001 to 2003. If I may ask you, I mean, this scenario, how much is this guy incurring the additional cost on this money he borrowed over the 3 years? What's the additional cost over the 3 years? What's the cost of borrowing this 10 million? Any guess for the 3 years? Can you tell me? Because that's what this 8.85% is actually representing. That's what it will help us spread over the 3 years. What is this guy making? Sorry, not making, no, paying as additional cost. Okay. So we have this scenario. The guy issued a 10 million 5% loan note on January 2001, incurred an issue cost of 200,000. The loan notes are repayable at a premium of 1 million on 31st December 2003, giving them an effective interest rate of 8.85%. So in this case now, the guy is making, in addition to this 5% per annum is going to make, not making now, is going to incur. He's also going to incur additional premium of 1 million, and is also incurring additional 200,000, making it like 2007 is incurring over the 3 years. So those amounts is incurring are actually reflected in the effective interest rates of 8.85%. And to show that, similar to what we have done earlier, we are going to recognize this using an amortization schedule. So in the first year, we said it should be recognized as the net proceeds, which is the amount he borrowed minus the issue costs, which is the amount he has incurred, given to probably a stockbroker or a professional to help raise the money. So 9,800. The effective interest rate is going to be the 8.85% on the 9,800. That gives it 6.7. But the interest you will actually pay is that 5%. And it can be on 9,800. This 5% is going to be on the amount he actually borrowed, which is the principal amount of 10 million. So 5% on 10 million. So he incurred 867. He paid 500. So the balance is the difference. That's around 367. By the time you add it to this 98, so is owing 10,167. What is key here is that this 867 will be recognized to P&L as finance cost, while this 10,167 will go to my non-current liabilities. In year 2, at the beginning, you have 10,167. Then you apply this 8.85% on the 10,167, and that gives us 900. Then it's paying an interest per annum of 500, which is fixed amount on the principal amount. Then the closing balance is this 10,506.57. Then in year 3, we bring it forward, 10,567. Then we'll have 8.85% on 10,567. And that gives us 933. Then we'll pay 5% on the principal amount, which is 500. Then our balance is 11,000, which is which coincide with this additional premium, which is 11,000 at the end of the day. So what is important here for us is that in year 1, the interest is going to be 867 that goes to P&L, while this one would be in my non-current liabilities. In year 2, this 900 would be my finance costs. Then this would be a current liability now that is due within 1 year, which is next year. In year 3, this is 933 also to P&L. Then I'm going to pay back this to settle it out. So it's just similar to what we have done earlier on. Just know that whenever you have the effective interest rates, that is what will suffice. So which I've explained here. Now, I have some questions here, but before I solve these questions on what we have learned so far, let me quickly talk about convertible instruments. Let me quickly talk about convertible instruments. And for convertible instruments, what this is looking at is a scenario where an entity has majorly, they call it um, convertible debts, majorly convertible debts. And the focus is that, okay, you borrowed money, and this money you have borrowed, you now give the investor the option to convert the borrowings to shares at maturity. It has that option that, okay, can convert it to shares. So the challenge here is this: if we borrowed money and we know from day one, I know from day one that this guy is going to convert this borrowing to shares from day one, that borrowing in my books, I won't even record it as a liability. I will record that kind of borrowing as an equity instrument. It is an equity instrument because I know that this guy is going to convert to shares. So we recognize it in our books as equity. But this case is a case whereby we are not sure whether the guy is going to convert it to shares or not. It's just like I borrowed money to one of you, and let's say I borrowed money from somebody, let's say 10,000, and I'm supposed to pay back at the end of let's say 2 years. But it is convertible if at the end of that 2 years you have a choice of either converting that money to my shares, that you now become my shareholder. It is not me, it's not my own option. No. It is you that will decide. So it's either you say, okay, you want to collect back your money back, you want to get back your money, or you say that you want to convert it to shares. So the challenge is that I don't know what you want to do. I don't know. It's just an option. So I'm not sure whether you would convert it to shares. I'm not sure whether you say you want to collect your money back. So the challenge I have is that how do I then classify the money I have borrowed? Because this money now is having like two elements. Am I going to recognize it in my books as financial liability or equity? So that's why sometimes the convertible is okay. So like I was saying, since I'm not sure whether the investor or the lender, person that gave me the money, will convert it to shares, or whether he wants to collect his money back, the standard says that when I'm recognizing that money in my books, I should recognize it as both liability and equity. I should recognize it as both liability and equity. So the challenge is this. Let's say I've borrowed, let's say 10,000. Then how much of that 10,000, am I going to recognize in my book as a liability? How much of it am I going to recognize in my books as an equity? So we're going to rely on the definition of equity from the conceptual framework. to do this separation. The conceptual framework said that an equity is a residual interest in the asset of an entity after deducting all its liabilities. Is a residual interest, is usually the balance. So in separating this money I have borrowed, all I just need to do is to determine my liability first. When I determine my liability, then the balance becomes my equity. So how do I determine my liability? Since I'm determining my liability at the date I borrowed the money, that is when I want to know how am I classifying it. Am I that's the day is the day I'm borrowing the money. I need to know the value of that liability. So the value of that liability is simply that, okay, I'm paying interest. Let's say I'm going to pay interest for the next 3 years. I just need to know, okay, what's the value of that interest now? That means I will have to discount the whole of that interest to present value. And I know that I'm going to pay principal at maturity. I just need to discount that also to present value. So that present value will now be equivalent to the value of my liability. Okay, so and that's what this entire explanation is talking about. Now, this will make more sense with this example. Look at this example here. He said that Ferry Limited issues 4,000 convertible bonds at 2021. The bonds have a 4-year term and are issued at par with a face value of 2,000 per pound, giving total proceeds of 8 million. See, the main thing here is this: Ferry Limited has borrowed 8 million. So 4,000 convertibles, it's just this 8 million is just 4,000 multiplied by 2,000. And it's a 4-year term, meaning at the end of the 4 years, it's going to pay back the 8 million. But now, when they say convertible, meaning that Ferry is giving the lender the option of converting to shares. But now he's not sure whether the guy is going to convert or not. And that's what I've explained earlier. Now, going forward, they said interest is payable annually in arrears at a nominal annual interest rate of 6%. So this is the nominal interest at the rate of 6%. We're now told that each bond is convertible at any time up to maturity into 250 ordinary shares. So they are giving us a clue that at maturity, if this guy decides to convert to shares, if that's what his decision is, he's going to get to 50 ordinary shares. Going forward, they said when the bonds are issued, the prevailing market interest rates for similar debts without conversion option is 9%. So this 9% from what we can see here is the market rate. But why is this 9% higher than the interest we are paying? Why is it higher? And the reason is clear. Is that this particular borrowing is very attractive and is less risky because I've given the lender the option of converting to shares. So whenever somebody borrows money, the lender is exposed to what we call financial risk, which is a risk that I might not pay back. But with this kind of contracts, the lender is secured because even if I don't have the cash flow to pay back, it can get to 50 shares. So, which is why giving them 6% is okay. Even though outside in the market, they can get 9%. But because this one is less risky, so that's why this 9% is high. And that's how you're going to find it in your exam. Okay, so this 9% is the market rate. So this question now asks us that what's the value of the equity component in the bond? So first, I've explained earlier that what we need to do is to do a separation between we are going to separate or componentize, or we're going to bifurcate this 8 million into financial liability and equity. So the first thing is for us to determine the financial liability. And how do we do that? We'll get the present value of the interest and the present value of the principal. The interest, since this is a 4-year term loan, and this I'm doing at the date I borrowed the money. That is when I want to enter it in my books. Now, this interest, I'm going to pay from year 1 to 4, and I'm paying 6% on the 8 million, which is 480,000. If you want to get present value of that, you are going to apply the annuity formula, which is this: 1 minus 1 plus r raised to power minus n divided by r. If you punch that to your calculator, it's going to give you 3.240. If I multiply that by 480,000, that gives me this amount. Then also the principal, which I'm going to pay back in year 4, I will have to get the present value of that, which is this 8 million. And whenever you are getting the present value of a future amount, we use a discounting formula, which is 1 plus r raised to power minus n. That's very different from this one. This is whenever you want to get present value of annual amount. Annual amount. If you're not just annual, equal annual amount. You use annuity, which is this. But for this one, we use discounting, which is this. So by the time you multiply 0.708 with this 8 million, we get 5.6 million. When you add these two together, you get 7.2 million. And this 7.2 million is the value of the financial liability. The question asks for equity. Equity will just be the balancing figure. By comparing this 7.2 with the total amount you borrowed, which is 8 million, the difference will give us 780,800. So at this date now, if he wants to enter this in his book on this 1st January 2021, he will just simply debit cash or debit bank with the amount is collecting, which is 8 million. We'll credit financial liability with 7,219,200, and we'll credit equity with 780,800. And that's how he's going to put it in his books at the beginning of the year. And that's that for that question. Now, this question 2, that one wants to go a bit further. That what even happens at the end of the year. So similar to question 1, would have a company issue 20 million 4% convertible loan note at par on 1st January 2021. The loan notes are redeemable for cash or convertible into shares on the basis of 20 shares per 100 naira of debt at options of the loan note holder on 31st December 2024. We're now told that similar but non-convertible loan notes carry an interest of 9%. We are required to show this loan note to be accounted for in the financial statement at 31st December 2021. So this is also a convertible loan note. And whenever you have that, you have to separate the money you borrowed into equity and liability at the date you borrowed. In this case, January 2021. So in January 2021, we determine the financial liability. And in determining the financial liability, we'll get the present value of the interest and the present value of the principal. The present value of the principal, even the interest is just 4% of 20 million, which is 800,000 per annum for 4 years, using the effective interest rate of 9%. The discount factor is going to be 3.24. If you multiply that by 800, it gives us 2.5. Then the principal, which is 20 million, multiply that by 0.708, which is the discount factor, just like we did in previous example. Multiply that, gives you 14.1 million. If you add that to this 2.5 million, that gives 16.7 million. The equity is the balancing figure. By comparing this liability value with the amount we borrowed, then the balance is going to be this equity. Again, just like what we have done here, at the beginning to enter this in our books, we just simply debit bank. In this case, the amount we collected is 20 million. Would credit the liability 16,752 and the equity 3248,000. Now, where I'm going is at the end of the year, the liability of, you are going to be paying interest, but the equity will not change. It will be the same thing all through the life of this instrument. But the liability will be changing because on liability, you have to pay interest. So at the end of the year, we will get the value of the liability, just like I've taught you before. So just similar to that table I did earlier when I was teaching you amortized cost. So the balance at the beginning is this 16,752, which is this liability value that I also put here. The interest payable is going to be 9%, which is the effective interest rate or the market rate on the liability. That gives me this finance cost of 1,507. This is what goes to P&L. And the interest I paid is the nominal interest on the amount I borrowed. It's always fixed every year. And that gives me 800,000. Then my balance is 17,459,680. And doing a statement extract, in my statement of profit or loss, what goes to my finance costs is 1.5 million. And in my statement of financial position, I have my non-current liabilities and the convertible loan note, which is this amount. It goes to my statement of financial position. And this equity also will come in under equity as in my statement of financial position also. And that's how this works. So convertible financial instruments is just all about, it's no more than this, separating the amount you borrowed into liability and equity and making sure that at the end of the year, you'd do your amortized costs for the financial liability to get the amount of interest that goes to your P or L. Okay, so that settles convertible instrument. Now, aside that, I have some few questions here. If you had listened to what I've been teaching you, these questions are easy and walk over for you. And I have some past questions here. I have some past questions here. It's the question that I kind of been asking on this area has really not been anything serious. If you look at, for example, now, these requirements here, they say we should discuss briefly how the debt instrument should be classified by the bank. If you read this one, you will see that they will just tell you that, yes, it's collecting interest, and the guy used to sell some of and I already told you, when the business model is to collect interest and principal and also to sell, then you should classify such as at fair value through OCI. And in this case now, he has invested, so it's a financial asset. So I would want you to attempt this. You guys have not been attempting any assignments in this class. You are supposed to attempt, send the solution to me, and I'm supposed to help you with the correct answer. So you need to learn how these things are actually solved in the exam. even though later we are still going to look at all these past corrections. That's mostly what we are going to spend some weeks in April to do. And